Depends where you're looking. I mean, a lot of the crypto space has relied on regulatory arbitrage, right? So they're essentially securities.
Mhm.
Basically, if you look at the Howey rule, they mostly meet the definition of securities. They're a centralized team or fairly centralized. They're raising capital to then work on something that is, and that with their work, trying to contribute value to that and make those tokens appreciate in price.
Mhm.
And so they've been operating in that gray zone. So I do think regulation would slow down them and take away a lot of the kind of the scams. But like if you look at traditional startup financing, right? So if you do a startup and you're either a developer, a founder, an early VC investor, you're tied to pretty much the success of that company, right? So you either need an exit, you need like either a company has to come in and acquire your company, which means like serious business people will review your company and decide that they want to buy that and put it into their company, or you go long enough and big enough and then go through all the SEC filings and you go public, and then you can get exit liquidity. Whereas what you see in the crypto space is you'll have all these early developers and financiers. They will, they'll issue these tokens for themselves at super cheap prices. Then, they work on their project for a couple of years, and there's a hype cycle. They get their coins listed on an exchange, and then they sell to the retail public. And then their project never really goes anywhere. It never actually really results in a product that people are using any sort of consumer basis.
Mhm.
And so you've detached the financial gains of the early investors and the founders and the developers from the actual success of the underlying project that they built, and that's not healthy. So I do think there's probably more regulation. It's unclear what it's going to look like. A lot of those can do jurisdictional arbitrage, so that if they can basically lose access to a large market like the U.S. or have their access restricted, but they can still exist by going to certain other smaller jurisdictions that are more open to those sort of things. But overall, I think that does pressure the industry. When you look at, say, the Bitcoin only ecosystem, I mean, Bitcoin's not a security. That's something that Gary Gensler has been very clear about. There's no issuer, never raised capital, so that's more like a digital commodity. But most of what you see in the space is more like a security. You can think of it more like an equity that just hasn't gone through the same sort of registration process. I think the market's sorting that out, kind of sorting that out now. I mean, I think one of the potential long-term solutions is Bitcoin if it continues to do well, but that's by no means assured. Right now, the problem is that there's no perfect one, so there's a hodgepodge. I mean, that's why people have diversified portfolios, because you store it in equities. They generate, if you pick profitable ones, they generate cash and dividends. You can also store it in real estate. I mean, the problem with all that is it's essentially non-custodial, right? You're tied into that country's ecosystem. It's not very mobile. You can self-custody gold. That's partially outside of the system, but good luck moving that around globally in any sort of sizable amounts as a bearer asset. Bitcoin's really useful, but it's 14 years old. It's very volatile, so you can't. Most people can't put all their money in Bitcoin, or it's hard to say exactly what Bitcoin's going to look like in 30 years. And so it's really about a bunch of existing options, a couple newer, interesting options. And I think right now you have to kind of hedge your bets. You have to diversify a little bit based on your volatility profile and based on the research that you do. So I like a combination of precious metals, equities, some real estate, and Bitcoin, kind of this mix of different types of assets.
Mm-hmm.
A couple of points. One is that let's go back to bank accounts for a second. Banks have been around for centuries, and in 20 years, smartphone adoption has now just exceeded bank account adoption. So more people in the world have a smartphone than a bank account, and probably in 5 years that gap will be wider, because the rate of smartphone adoption is increasing because of the exponentially decreasing costs of the devices, especially the inexpensive ones, as well as all the infrastructure that allows them to have mobile data. And so basically that gives people global access to hold an asset, even a bearer asset, move it around, use the internet to exchange value, get financial services. And I think a basic premise is, why should it be the case that everybody who has a smartphone can access good money, access a global marketplace of monies, and get basic financial services, uncensorable payments, savings, things like that. And so, like, for example, one thing stablecoins do is they say, well, I mean, if you're an Argentinian and you want to hold dollars, you don't want to hold dollars in your Argentinian bank because they have a history of confiscating them. You could hold them on, you could hold them on a hardware wallet, and you hold stable coins on a hardware wallet, and you're still reliant on the issuer of that stable coin, but that issuer is not in Argentina, right? You've now accessed the global marketplace of dollars. And for some percentage of your savings, that might be a better risk reward than other things that are available to you.
Mm-hmm.
There's also been the same thing. We have essentially stable coins with gold, where basically instead of accessing gold physically, which I think is usually the best option, but if for some reason you can't, or you're traveling a lot and you want some gold price exposure, there are redeemable. There's kind of like an ETF, but instead of just trading for a limited period of time on an exchange, you have this globally trading token that represents redeemable claims for custody gold. And so you've essentially abstracted gold, and now you have you still have counterparty risk, but you can choose what counterparties you want to work with and have that price exposure. And I think the last point there is, in the United States, stocks trade at about 19% of the time, right? So they only trade a handful of hours each day. They only trade 5 days a week. They don't trade on holidays. And when you add that up all together, throughout the course of a year, their trading hours are 19% of all the hours in the year. So the other 81% of the time, they're not trading normal hours. There's after hour stuff, there's futures, there's things like that, usually not accessible to retail as easily. And essentially what I think a reasonable question to ask is, why can't they trade 24/7 like stablecoins, gold-backed stablecoins do, Bitcoin, things like that? And then also, let's say you're in Nigeria and you want to own Apple stock. That's kind of hard to do sometimes, unless you're wealthy.
Mm-hmm.
But if you could have any sort of traditional security be accessible to anybody with a smartphone, I think it opens up the types of assets that people can own globally. And so I think those are reasonable questions to ask when it comes to, can you improve both the money rails and then the trading rails? And I think the only thing I would differ on is a lot of people in the broad crypto space focus on those trading rails, those leveraging rails. And while some of that's interesting, I think the most important thing that the world lacks is a good sound money. I think that's where it's worthwhile to focus.
Mm-hmm.
So I think medium term is just challenging all around, because we have various, in this year, 2023, we have a bunch of U.S. recession indicators. That's partially offset by China's reopening, potential emerging market opportunities, dollars, off of its highs. It's unclear if it's going to stay there or not. And so there's a lot of uncertainty in, say, a 6 to 12 month period. I am pretty bullish on precious metals. I'm always tricky with 1 year forecast, because you have to be right about the fundamentals, but then you also have to be right about what people are going to pay for those fundamentals. And that's, in 1 year, that's like a guessing game. That's, it goes back to that old quote, like, in the short term, the market's a voting machine. In the long term, it's a weighing machine, right? So over the long term, they reflect fundamentals. In the near term, it's mostly sentiment, liquidity, things like that. And so I think there are plenty of opportunities in emerging markets. If you look North America, I think that pipelines are still pretty attractive. I'm long-term bullish on energy. Unclear for this year because of some of those recession indicators, but long-term bullish on energy, precious metals. I'm less bearish on banks than a lot of people are. And then I do like a Bitcoin allocation and just select equities in different sectors that I think are recession resistant, or that, might face turbulence in recession, but that are well positioned to get through it and then provide good 3 to 5 year returns from there.